So, hi everyone, this is Finance Meets Real Estate. We have Nathan Trunfio. Do you pronounce it correct, Nathan? Yeah, Trunfio here today. So he's the Senior Director of Sales at Lima One Capital. As some of you know, Lima One are like a known asset-based lender. So they do residential lending. They also do commercial, large multifamily lending as well. So Nathan has spent his entire career in the lending and real estate industries, where he's had experience as a sales manager, trainer, director of operations, capital markets, credit officer, etc. So he has his company offers financing on fix and flip new construction rental properties portfolios, as well as multifamily bridge loans. What he's going to talk about today is the do's and don'ts of submitting multifamily deals to a lender, his perspective on the investment markets, multifamily investment markets right now. Again, as I mentioned, the focus is going to be multifamily and bridge, so bridge loan, commercial loan space. And yeah, so I'm going to pass it on to Nathan. And thank you so much for joining us today, Nathan, and sharing your time with us.
Thank you. I appreciate the opportunity here. Not only myself, but our entire company and team is really just passionate about what we do, and for a number of reasons, just because of the impact that we provide to our direct clients, but then also to many of the communities that we hope to continue to revitalize with that's being done by a lot of the operators that are boots on the ground and using our financing in order to navigate through their different investment strategies, not only to create and grow wealth for themselves, but again, for the surrounding communities. So great welcoming here, Stefan. I think you did a great job giving a summary of sort of what we do, Lima One Capital. But just for very brief sake of background, we've been in this lending space, financing only real estate investors for about 10 years. All of it has been with a residential focus, and residential also including multifamily, as multifamily is servicing, the residential residents and tenant base. And all we're trying to do is just provide solutions for real estate investors. We know that many a times banks don't quite align with what investors need in order to move quickly, sort of minimal documentation, some creative leverage structures and loans that can allow you to reposition or aggregate properties, and again, create more opportunities for households across the nation to rent, to own, and things like that. So Stefan, I'll leave to you on where you'd like me to begin, because I think we got a number of topics that we can go through, but you point me in the direction that you want to go.
Yeah, just as a quick question, like I'd be curious, and I'm sure others may have other questions as well, and feel free to put them on the chat or speak up both ways. But I was actually curious if you look at the asset-based space, right? So we have, for example, like Finance of America Commercial, right? It's one of your competitors. Now I know they did like an SPAC sort of IPO earlier this year, I believe, like 1.9 billion. Is that correct? Like, so that's something that is, maybe indicating that, okay, that's a product that is like very viable, like asset-based lending is a very viable product in my space. It's sort of, to me as an investor, I feel it a little bit takes you, has this no W2 capacity, right? It's a great thing for, real estate investors, that it just takes you out of the system, so to say. You no longer need to be tied to just in the residential space, tied to a W2 in order to be able to execute your deals. And even with the commercial lending before, it's to an extent, there is some reliance on your W2 income, at least at the, cheaper commercial deals, etc. So, but how does that work in the multifamily, call it multifamily asset-based lending? Like, what is the value add that you guys have in commercial asset-based?
Yeah, so I think I want to take, it's a great point and a great question. I want to address it in a little bit even bigger perspective, because one important thing is our industry is called a lot of different things. Asset-based lending, hard money lending. A lot of times nowadays, and what a lot of my peers, our competitors, prefer is private lending. But realistically, it's actually crazy. Asset-based lending is essentially the first ever financial product that was ever out there, and it was 18th century BCE is when that started. So I'm not going to walk through all the history of how that evolved, but essentially, way back in the day, People were figuring out how to give others money, and it was just based on the assets, a hard asset that they have. So let's fast forward to sort of our industry in the 2000s. There were a small handful of lenders that specifically focused on real estate investors, both residential, like single family, and commercial in the 2000s, in the so-called crash. There were not many of them, but I believe in our space, sort of Dwell was about the first larger known lender in the space. So the crash happened. There was a lot of distressed inventory, both single family and multifamily. And real estate investors said, wow, this is a phenomenal environment for us to buy properties cheap, but we don't have anybody to finance it well. So that was really the birth of our industry. Again, we like to call it private lending. So as you continue to fast forward, nowadays we have full institutional acceptance behind us. I mean, we, Lehman One Capital, were recently bought out by a publicly traded REIT very recently. So we have literally institutional billions of dollars behind us to lend out to good investors in single family and multifamily. And then there's a lot of other players, whether it's Genesis backed by Goldman Sachs and others, where it's really cool to see that us real estate investors and operators now have institutional backing at a very high caliber that has allowed the product to get very aggressive in regards to the leverage offerings, but also in cost of capital. Because it wasn't too long ago that average terms were 14% and 3, 4, 5 points, whether that was single family or multifamily. So to me, I think it's important to understand where we've come from and where we're going to continue to go. The product's only going to continue to get better because, again, we have extremely deep pockets behind us. So more to your point, how have we and others sort of morphed into multifamily is, again, where all of it is considered sort of residential focused. And a lot of what's done on the single family side can translate into multifamily. And then what we found in the private lending realm is there are a lot of really great banks and lenders that will offer, especially bridge financing, to what we call the middle market space. So middle market typically by definition is starting around the $5 to $7 million mark. And there's really competitive products there. There's been ways to finance that for 1 to 2 decades. So it's a pretty robust, pretty well-established, financing vehicles for those types of multifamily assets. But there's been a huge void for more of what we call the small balance multifamily financing. Most of that's been done traditionally by local regional banks, banks that can wrap their hands around smaller multifamily assets, where to larger institutional sources, those assets are a little bit too small to bank. So we in the private lending space really saw that as an opportunity. We've grown in the single family predominantly, but then saw this opportunity in more of the smaller balance. So typically smaller balance is smaller unit sized. And the other thing that's sort of combined well with our single family strategy is that a lot of people, and probably listeners here, you're actively investing in real estate to scale it and to grow passive income, mailbox money, generational wealth, so on and so forth. So as you continue to grow, whether you started in single family or not, most people want to just do more. And from a lot of people's perspective, there's no better way to do it than multifamily. So we found a lot of our clientele that was predominantly single family wanting to move into multifamily. We also saw this void of sort of the smaller balance loans that didn't have a big home or a good home for anybody that can lend nationwide. It was more regionally lent on those assets. And that's really how us in the private lending space, like the Finance of America Commercial and other peers of ours are now lending in multifamily, where historically we started in single family, but our clientele has moved into multifamily, and we found a big void and need for financing on multifamily assets. We specialize specifically in our minimum loan amount on multifamily is $250,000. And then we can go up to about 20 million, but our sweet spot is 250 to about 10 million. And that's sort of, again, the hole in the void that's left there for people trying to find really good, competitive, aggressive financing for multifamily assets. Does that answer the question?
Yeah, that does. That's great, Nathan. And what about the institutional backing that you mentioned earlier, let's say from Goldman Sachs, et cetera? So that's a sort of institutional interest in sort of institutional backing for asset-based lenders from that perspective, sort of providing the original financing to you guys who then sort of turn it to investors from that perspective. Is that what you meant, or?
Yeah. I'm glad you pointed that out, but that's absolutely what I was alluding to, is because a lot of people don't quite know how lenders are structured or capitalized or how they have all their money. And so really it's no different than any operator that's looking to get financing. We as lenders have equity, and then we also get loans on our loans. And those loans, we need a very big lender to support the, hundreds of millions of dollars that we're putting out in a given month. And so therefore, who has deep enough pockets? Wall Street and institutional banks. So a lot of lenders have been recently, over the last year to two, bought up. There's a couple that are about to be acquired, is word on the street. And so how does that happen? You can take some institutional equity and then all of the financing that those institutions get, and we can package that all together to put together a really strong product for an end user. So at the end of the day, lenders use their own equity and some financing of their loans, just like any investor is going to bring in their equity on a deal and find some financing in order to fill out the capital stack.
Yep, that makes sense.
It's very, very interesting. And very honestly, all of that's to benefit a borrower and an operator, because as institutional money continues to come in and has come in, as there's that acceptance, they're bringing cheap capital to us. And sure, we all need to make money to stay alive and to employ others and grow a company. But at the end of the day, our space is getting more and more competitive. And so how do we remain competitive? Is we offer a strong product. What's a strong product? Lower fees, lower rates. So I can tell you, we are now at product levels that are more aggressive, cheaper cost of capital than prior to the pandemic. And when the pandemic hit us all, we all thought that would never be the case. So it's interesting that all of this institutional and additional money coming into the space is really only going to benefit the borrowers and operators, because we all want to work with you. We all want to help you grow. And we know in order to win your business, we have to offer a very competitive product, and having institutional money allows us to offer more attractive terms.
Understood. And just to like a quick clarification, in the multifamily space, it's only bridge financing that is currently offered. It's not like rental, for example, like rental loans or something like that. No.
So depending on when somebody listens to this is the beginning of September. At this moment in time, we are currently Lima One Capital only offering bridge financing. Before the end of September 2021, we will actually have a permanent financing product for multifamily rolled out. It's in the mix. We're doing some sort of beta loans. We've done about 8 or 9 of them already. So that will look like there's a bunch of different options. We'll be able to structure interest-only loans for 5 to 10 years, fully amortized 30-year loans, fixed for 5, 10, or possibly 30 years. Rates on those will be in the 4s to low 5s, depending on what the qualifications are. But again, that is another big void, is the smaller multifamily properties, unless you are an in-state operator that can go to a local or regional bank. Local regional banks typically don't lend to people that are not in state, typically, not always, but typically. And so there's just a big void for people to go out there and get financing on smaller balance, smaller multi properties. And that's the product that we're going to launch to fill that void. Yes, there are the agency lenders that many people know about and love, and they bring liquidity, they bring capital to the market, but they specialize in loans. Their minimum loan amount is $1 million. And they certainly have a little bit harder requirements than we will have on our product, because ours is more of an ease of use.
Yeah, sounds good. And so you mentioned, Nathan, you wanted to share like your outlook on the multifamily, like the investment market. So let's say because you guys look at a lot of deals, right? You get a lot of like investment insights. You can see like people's business plans, et cetera, et cetera. So like, what is your view currently as for what kind of deals are people doing? Like, what do you feel are the most competitive or less competitive sort of areas?
Yep. Yeah. So it's a great question, because there's a lot of feedback. There's a lot going on. And honestly, week by week, month by month, we see things changing. Many of us had thought that the industry wouldn't be as aggressive and strong as it's been, but anybody that guessed that, including myself in the pandemic, has been absolutely wrong. I use a strong word, I call it the F word, but many of us know that the multifamily market right now is very frothy. That's the F word that I wanted to use, not the curse word. And so there is more money than ever coming into the multifamily space from the equity side, whether it's LP equity or high net worth individuals that just want to invest their own self-earned equity into the game. Or, as I said, my peers and I in the lending space there's a lot of money to be deployed into the space. So that's allowing for deals to happen, because to your great question, what are we seeing boots on the ground? We are seeing more people move out of primary markets. They're starting to grow where their assets are, to either crossing over county lines or crossing over state lines, mainly because they're just having a hard time finding inventory and product to buy. That's no different than you read on the news and things like that. But what's really interesting is that as a result of that, what we're seeing is people moving into secondary and tertiary markets. We actually specialize in financing secondary and tertiary market deals because not everybody will do that. But what we're seeing is that because the money is expanding outside of sort of the urban core, outside of the primary markets to these secondary and tertiary markets, it's driving up pricing in multifamily assets higher than they've ever been in these markets. So to me, the question becomes, can the market sustain and handle it? The one thing that we see a lot of are people still trying to do what we'll call cap rate play. And what I encourage everybody is, we all know where we're at in the cycle of the market. Whether we're at the top or we're just close to the top, you have to keep that in mind. So to expect to buy an asset and for cap rates to compress, it's probably not that realistic. Same goes on how people will put together pro formas on income and expenses. We encourage people to just heed caution in how aggressive they are and making assumptions of how much rents will increase. And if they do, expenses are probably going to go up at the same amount of time. But the one thing that I'm very keen on, and I encourage everybody else to be, you'll read about this a little bit in the news, but probably not enough. There is an affordability crisis out there. And so as people are needing to make the numbers work for not only their own equity, but for lenders, they're really pushing their pro formas and their assumptions to the maximum. And what a lot of times we see often overlooked is, can the market that you're buying an asset in sustain? Can the tenant base afford your rent payments? Because it's easy to say, oh, I can increase rents. Most value add plays are revolving around increasing rents, either because of better management or because of investing capital expenditures, renovations into a property. But once you renovate it to a high end or just improve the quality of each unit, can the tenant base in that given market afford it? In a lot of secondary and tertiary markets, you can't change the income demographic of the people that live in the property around you and that are going to potentially be residents there. So you need to be mindful of that level. So I went into a number of specifics there, Stefan, but the bottom line is we're just seeing a lot of frothiness. There's a lot of money out there, a lot of money that wants to get into the multifamily game or is in it and wants to go even deeper in it. And we're seeing just a lot of people sort of push the limits in how they're looking at deals to make sure that the numbers, show profit to their own equity or the equity that they raised. And, just encourage everybody to be diligent and conservative while you're looking at deals. And that's hard because it's hard to find deals right now. So that's one of the reasons why people are sort of pushing a little bit of the limits on how they're trying to make deals work from a financial and pro forma perspective. So I could probably keep going, but I'll stop there. I think I gave you a good amount, but we're seeing a lot of action. All that to say, multifamily investing is still it's a great asset class. It's a great opportunity to invest in it. You just need to be diligent in how you're looking at deals and what you're willing to pay for something.
Okay, and so what do you think are, like, you're mentioning some of the things that you see like overlooked by the sponsors, let's say. So it's more like aggressive assumptions in like exit cap rate and that, or do you see other kind of potential pitfalls that sponsors, let's say, like from the perspective of investors as LP investors, let's say, in those projects, like what are some of the risks that you see?
Yeah, so a little bit of manipulation through the exit cap rate. We absolutely see that. It's hard to tell your in place going in cap rate. How good or bad that may be. It's tough to say because it's moving all the time. The other consistent one that we see again are people trying to sort of over improve an asset. And the really interesting one is people buying stabilized assets and expecting to very quickly reposition the asset and increase rents across all the units, which, based on the fundamentals of supply and demand, most people can see in markets there's room to increase rents. But how quickly can you go through that? Especially when you've had these eviction moratoriums, it's been hard to get people out of units. So if you can't get people out of units quickly, then you're going to have a hard time navigating through repositioning an asset and moving people out and getting higher paying tenants and residents into those units. So, there's a lot of that. And then the other is, we see a lot of people that, everybody wants to think, and most people can think that they can better manage the property than the owner before. And although that's very viable, there are certain levels of sort of your expense ratios that, probably become unrealistic in certain parts of the country, especially just given, conditions. I mean, you see what's going on with weather, whether it's the unfortunate Hurricane Ida, or just seems like every storm just gets worse. And so there's just other additional expenses that are just never going to be able to be reduced to levels, no matter how good of a manager you are. And so we see a lot of that play too, is people just driving down expenses significantly to drive up NOI. But the question becomes, how realistic is it to be able to get to those levels? And it's to be determined. And I think over the last number of years, a lot of operators have been benefited. They've gotten tailwinds from the market. They say rising tides raise all ships. So, we've all benefited from the appreciation of properties, the compression of cap rates, the increase in rents. How much more can that continue? And can you expect the same levels of it if you look back the last couple of years? That's to be determined. And I don't mean to scare anybody with all these items, because I covered a lot of the different strategies, because you're usually either renovating an asset to increase its, increase NOI eventually in its value, or you're just better managing and filling up a property with better paying tenants to increase your NOI and therefore your value. Those are the main strategies that we see. It's just how you get there and how realistic is it is where, I really encourage everybody to make sure that it's reasonable.
And let's say, what about IRR, like for our audience, like internal rate of return, or that's not something that gets submitted to you so much, I assume, like, because it's more like debt service coverage. And so
yeah,
that kind of manipulation code, it's not something you see. Or
yeah, but
so,
look, the way that we underwrite does align more with cash on cash, and a lot of people will analyze your cash on cash and your IRR. But what I can tell you firsthand, just from seeing a lot of deals submitted to us for financing, whereas I'm just going to be anecdotal, but 2 to 4 years ago, a lot of people were always targeting high teens to low 20s IRR. And we've seen a lot of people targeting a lot lower return hurdles on the IRR level. And again, a lot of IRR can be manipulated by cap rate, your exit cap rate as well. So, we see a lot of pro formas that somebody may expect, because we'll see the IRR in there. We don't underwrite to it, but we see what it is, and they expect it to be a 19 or a 20. And then after we're done underwriting it, probably a little more conservatively. And not to say that the business plan originally was wrong, we're just going to be a little bit more conservative. It ends up penciling out at a 14. But there's a lot of LP money and a lot of people that are very happy with 14 IRRs. But IRR is a tricky one, man, because you have to take the amount of risk into play, because you could show a 30% IRR on a completely vacant asset, and that sounds great and all. But if you look at a 12 IRR stabilized deal in the middle of a primary market, call it Dallas or Miami, there's a different level of risk in each deal. One has a long ways to go. The other one's already performing. And so that's where IRR, can be something that can be tricky for us lenders to look at in that regard.
Right. Yeah, completely agree. Completely agree with that. And actually, so you guys, so as lenders, like I know often like business cycles, they get kind of viewed or like proxied by credit cycles a little bit sometimes. So is that something like, let's say you on the lender side, like seeing all the lending, obviously contributing to, lending credit availability. So where would you describe, are we currently in the credit cycle, and then respectively maybe the overall business cycle?
Yeah, awesome question there. In the credit cycle right now, everything cycles between tighter underwriting, but with more favorable terms, to then looser underwriting with more expensive more expensive, less attractive terms. But, each underlying market that relates to that is conducive to it. What I can tell you is that us in the lending space were very much scapegoated for the great financial crisis in the 2000s. A lot of that was on the residential side, but I can tell you that it was rightfully so. Everybody was writing loans without a ton of diligence, and we saw what happened. With the very low cost of capital that we're in, the part of the credit cycle that we're in today, underwriting is very conservative and prudent. And so I'm very confident that, if and as there's more distress from the next wave of the pandemic or anything else that hits, us lenders and creditors are not going to be a reason as to why the market drops, of a significant manner, because the fundamentals are that much stronger. So where we're at in the credit cycle is pretty conservative and tight lending criteria and guidelines. There's been a lot of government entities put in place and rules and policies from the government that helps maintain consistency in how people have to look at deals. A lot of that are the GSEs, the Fannie Freddies that buy a lot of the multifamily permanent loans. So in the future, very likely, cost of capital will eventually start to go back up. Rates are going to go back up. The Fed just spoke to that here very recently. So as rates go back up, the credit policy will have to loosen a little bit. I think not only are we more conservative on the credit policy, given today's credit cycle, we're also just very aggressive with leverage. When you talk asset-based lenders, asset-based lenders are 60, 65% LTV historically. On the multifamily space, we're doing 80, 85% loan to cost loans. A lot higher leverage. And we can only do that by being conservative in how we look at it, because we don't want loans to go bad and we don't want to get hurt. What that means to the market, we're going to have to see, but I think there's no really room for rates to go down much of any lower. So rates are going to have to go up. Some of that will be related to some distress. But I think, for good, prudent operators out there, that means a lot more opportunity, because it's hard to find opportunities right now. So great question on the credit cycle. And I think we're going to start swinging back up with, maybe less attractive terms per se. But that's also going to be, there's more deals out there to make. And, there's still a lot of money sitting on the sidelines to come into the space on the debt and equity side, and also on the distress side. So I think it's going to keep the market propped up.
Okay, yeah, that's a great answer. So, but let's say if we look at, for example, the conventional financing space, and we say, okay, it's very prudent financing. That's maybe not it's kind of a more kind of standard example, but let's say we have conventional financing and it's prudent. I think generally that seems to be everyone's impression for now. But still, let's say we have Fannie Mae and Freddie Mac still expanding some kind of categories. Okay, let's say investment properties up to 4. You can have up to 4. I think now they increased a couple of years ago up to 10. Like these kind of small things. Mm-hmm. I know some of the condo requirements that were, some of the condos that were not qualifying for conventional financing, then that was expanded a little bit. Some of the condo project guidelines and requirements. So there's still a little bit more credit availability. If you were to gauge, where are we maybe in the business cycle or the real estate market cycle based on this, would you say it's kind of in the middle, based on the credit availability, or what would be your just very high level, high level answer?
I think that's a great question. And I would, if you're going to force an answer out of me, I think we're at the upper end of the pendulum swinging. I think there's probably more room for things to go down and get a little bit worse in regards to really credit and the fundamentals of the market, just because, if you think about real estate being in 10-year cycles, or the economy being in 10-year cycles, we're well past 10 years, or pretty well past 10 years now. And rates can't go any lower. Most people are already looking at that property sold for what cap rate? Holy smokes, I didn't think it would go, that low. So I think that we're at a high. It's going to have to come back down naturally. But I think you made a great point there, Stefan, is, Lima One Capital in our space, private lending or hard money lending or asset-based lending, whatever you want to call it. We're really here because the conventional lending space has become pretty conservative and sort of in a box. And we all know, as real estate investors and operators, we don't live in a box. You can't put us in a box. We can't make money if we are in a box. So therefore, there needs to be other more creative, more lenient, or more open-minded, common sense-based lending policies and outlets to go. And that's where someone like a Lima One Capital comes into play. We bring that common sense. Everybody in our credit committee is an operator as well. Whether, I think the least amount of doors owned is about 15 in all of it. I think the most is about 150 doors. So the people making lending decisions actually also operate. So we're not just like bankers and stuffy, in a stuffy office and suits, making decisions. Like, we also know what it takes to reposition an asset, go out and acquire more, and so on and so forth. So there's been more different types of options. There's more types of bridge loans than ever before, which are non-conventional types of methods. And then to your point on residential, there's always been, for the last number of years, what's been called non-QM loans that fit outside of the conventional box for 1 to 4 unit single family homes. The amount of non-QM loans, these non-traditional loans, are growing significantly. And it's just because there's a need for it. The box has gotten a little bit tight. So therefore, the government sponsored entities are not going to get themselves in trouble. They're going to have to stay in those tight lanes. But other opportunities, in the investor space, other debt funds are going to come out and bring their own product to market that don't have to conform to the boxes. And that's where real estate investors are benefiting. And that's what's going to continue to happen is if the market starts to go the other way, credit policy is going to have to loosen. As credit policy loosens and lenders take more risk, they're going to have to charge a little bit more for that risk. That's just sort of the fundamentals of the credit cycle. So, again, I think we're at the top, which means, pricing of properties are high. And then really that top in lending means that, our cost of capital offered to a borrower is low. It's going to go the other way here. And I think we're probably getting close to that top. So top quartile is what I would say.
Okay, so when you said, you made a great point with regards to, investors sort of by definition, they're outside the box, right? They want to find the deal, they want to find this kind of unique opportunity and be able to finance it as well. But then would you say in asset-based lending, I don't know the history as far as how far back was permanent financing offered in asset-based lending, because I feel that's more recent, right? I feel like it was always this kind of expectation of hard money lending being, sort of just bridge and, executing a fix and flip or something like that. But to me, something like a rental loan or what you guys are putting in the multifamily space in permanent financing, that's pretty outside the box, because that's where typically it has been historically based on the income that the person has and so forth. So
yeah, it's a great point. And I think, look, I don't think that asset-based lending is probably the best way to describe us, because asset-based lending is, lending just off the asset and taking on risk, and, lending, taking on risk, and there's less risk because you're just attached to the asset, but there's not as competitive of a product. We're also not hard money lending. There's been regional hard money lenders for quite a while. So, realistically, we're probably best categorized as soft money, a little bit easier to get, but not as hard to take as hard money lending. And then to your point, without going into significant detail on the capital markets and, all the institutional forces and beasts that have allowed for this, the bottom line is that we've shown in the fix and flip, in more of the bridge, single family and multifamily lending space, we've shown proof of execution. We've shown really good performance in those types of loans. And then you couple that with what I said, institutional money is backing our industry now. Well, institutional sources they're less risk averse. They have these permanent financing products. So as we get institutional money, then we say, hey, why don't we combine the strategies that real estate investors have and need, and also combine it with the financing that you're used to, and start creating products that will provide a solution to operators. And again, many operators want to grow and scale. They want to do more. They want to own more. And the only way that you can own properties for a while is to have some reliable financing. And so permanent financing was a need that had to happen. And how did it happen? Again, the easy way is that institutional money is accepted our private lending, soft money lending world. And then we've been able to bring products from the more institutional traditional realm tweak them a little bit so that we can offer them to real estate investors and make sure that they're solutions for the financing that they need. So that's very high level. There's a lot more detail I could probably get into being my lending nerd self and talk about, but probably leave it at that.
Yeah, that's great. But would you say that's more in the past 5 years or so, or is it longer that those permanent financing products were offered?
Yeah. So great question. And simply put, 3 to 5 years is absolutely the range to where a lot of bridge lenders or so-called hard money private lenders started offering permanent financing product. Great question and very accurate, the 5-year mark for sure.
Okay, got it. Yeah, that's pretty interesting. Yeah, at least to myself, I feel that's a big, kind of a big thing for investors. But then, as far as you mentioned interest rates, now interest rates are obviously very hard to predict. And I know now everybody expects interest rates to rise, and also sort of maybe assuming in correlation with inflation, etc. That to an extent exists, maybe, but maybe not fully. But then, what is your still after all, interest rates could go lower. That has been the case in the rest of the world. So, still US did not get to reach, if we look historically, okay, since 1980 and 2020, let's say, so for 40 years is let's say nominal interest rates dropping and real interest rates as well. So like a 40-year decline. So now everybody says the trend is going to reverse just now. Is that the case? Maybe not, I don't know. Or maybe the whole 40-year trend is actually could continue. And then if that's, towards the, where Europe and parts of Asia are, which has been even less. Now, I would more side with the rates increase side, of this argument, but just saying. And then the other thing is, I know like investors, they always say, okay, there is cap rate compression, cap rates are so low, but it's the spread of cap rates and interest rates. And I listened to like a lecture by Neil Bawa, like the data scientist, multifamily investor. And so he had, like one of the charts. And that's pretty available. So like cap rates, interest rate spread recent was actually pretty healthy, it was pretty great. So, so even though cap rates have compressed, it's really the spread that we care about, that investors care about. So that's another point. But, it would be interesting to see, do you think like if interest rates rise, that would lead to a decline in asset prices, or do you see it as more of just a slowdown of the current growth that we've seen?
Yep. Yeah. So you make some great points in that, and I would just based on historical macroeconomics, I'm pretty confident that pricing will start to drop as interest rates rise. And I think right now, some of the so-called frothiness in the market is, it's allowed and it's enabled by having very cheap capital because of essentially the spread that you alluded to of cap rates and interest rates. So I think that, that is really going to be the case. I will also say, you asked me right when the pandemic hit, I still thought rates are going to go up pretty soon, but I'm very confident that, rates, if and as they go up, will be very gradual. It will not be big rate hikes. And I think we saw proof of that in the US here, with what the government's done and pumping in all this stimulus money for quite some time through the pandemic to keep everybody afloat. And I think what's become very evident to me is that, whether it doesn't matter where you're at in regards to politics, I try to stay out of that, but I think the government's going to continue to keep things propped up. And one of the levers that they pull is controlling, Fed funds rates and interest rates, essentially. And I don't think that United States is a country of winners, we hope. And I don't think that the government's going to let us lose. And, we would lose if there was a 1-2% interest rate hike very quickly and dramatically. So I'm pretty confident. I think you make a great point. Rates could go absolutely lower if that's what sort of the powers that be think need to happen in order to keep things sort of afloat. While there is some still real distress out there in a number of different regards. So, I think it's a great point you make, Stefan, is rates could definitely go lower. I do think that generally they have to go higher, and as that happens, pricing will come down naturally just due to the fundamentals.
Got it. Do you guys have any questions? If you want to speak up, or if you're shy, you can put them in the chat, since I've asked a few questions myself now. So,
hey, this is Randy. I have a question about brokers versus direct lenders. So if we were working with a broker and they identify a lender for us, and we work with them on a deal, that's all done and great. On the next deal, is it advantageous to work then directly with the lender and kind of cut out the broker to get a better terms, better rates? I mean,
Yeah.
I don't want to do that. I don't want to cut out the broker, but I'm watching the bottom line.
Yeah, Randy, great question there. And it's an interesting one. I can tell you as a lender who we work in, I don't know exactly how many of our loans, but probably around about 40% of our loans are brought to us by a third-party broker. We protect the broker's sort of relationship. So if you tried to sort of backdoor a broker, we're gonna reach out to that broker and sort of let them know and make sure that we retain that relationship with them. So for better or for worse, that's how most lenders will work. Sure, brokers always have to make a dollar. We all got to make a dollar, but at the same time, lenders like us, we end up having to, and what we do is reduce our fee, our margins and our rates so that a broker can be compensated fairly. And then the ending product to you as a borrower is very competitive. So, with good lenders and especially with good brokers, it's probably important to go back through that channels, because brokers serve a phenomenal place in this marketplace, especially with the real estate investor lending, single family or multifamily financing landscape. And what do I mean by that is that outside of sort of the agencies, but even agency loans, our lending in commercial real estate or business purpose only loans lending is very non-standardized. And what I mean is that, in the residential lending, Fannie Freddie, which is, a significant percentage of all loans to homeowners, you have to write loans certain ways. And there's automated underwriting guidelines that everything has to fall into. Well, in the commercial space, there is a lot of consistency, but then there's also a lot of vagueness where lenders use their own discretion in how they want to lend. So therefore, brokers have a great place in this marketplace because they are specialists in understanding what lenders specialize in one realm or another. And very honestly, Randy, too, the wind comes in and the tides come in and out and blow and change too. So one lender that was really good for your last acquisition may not be as good for the next one because no two deals look the same. And then lender strategies are also changing. So, to your original question, most lenders will respect the original relationship. And also, brokers serve a great place in this marketplace because they truly understand lending. And the good ones know how to line up a borrower with their asset and their investment strategy with the right lender to give them the best terms.
Great insight. Thank you.
Yeah, I have a question on kind of, because you mentioned like some of the outside the box terms, right? And I know people who that you guys could offer like for specific projects. So I think one of the things that investors sometimes are interested is like partial lien releases, let's say, that is offered in the commercial space. Okay, so in the event you have an asset that is, let's say, a multifamily asset, and that asset is a single whole asset that is not segmented in any way, let's say, it has a single title, like that's in commercial space, I believe may not have any option for any partial lien release, right? Because it's a single title, it's a single asset. Is that feasible in the asset, or how you call it, like soft money space, like, or would it, or is it going to be the case, okay, only when that asset is actually segmented in whichever way, be it subdivision, conversion, etc.?
Yeah, so probably the best way to address that globally across all different types of asset classes and loan products is that most lenders, they will spell out a provision of a lien release to some extent. But to your point of if it's a single asset with one property standing on it, it may not be needed, but a lot of the loan docs still have it in it. And I can tell you that everybody's a little bit different in how they write that, loan policy. But the one thing that always holds true is it's at lender's discretion. So that's almost everywhere is, the ability to release, do any part of a lien release is at lender's discretion. On the single asset multifamily on one parcel, The most typical one is there's an out parcel that you want to split out and you want to go develop other multifamily, single family. I mean, I've seen it all for split it out and do a dock on the waterfront.
To clarify, sorry to interject, Nathan. So to clarify, so when you say, so suppose you have a multifamily asset and it has, let's say, X number of units. So can you have a partial release of one of those units in the event? I mean, just like it's kind of maybe a too technical question, but I was just curious if that's how that works compared to the commercial space. Can you have like a partial lien release for one of those units before that subdivision or whichever other separation has yet to happen? It's initially a single, it's a whole asset.
Yep.
But you are able to actually do a lien release upfront, is what you're saying, or that's
it's not upfront. It needs to be, you need to talk to your lender and sort of call it apply for it or request it is probably a better way to put it. On a multifamily asset that's on one parcel, I don't think any lender is going to let you release one unit, because if it essentially affects the marketability of the entire asset and it's not properly deeded that way, and you have to get a lender's approval to individually parcel out one of those units. Obviously, condo complexes, usually non-warrantable condos, you can run into, the likelihood of potentially having a lender release a single condo unit, but those are deeded individually with their own APN numbers. And again, if it's true multifamily product, one structure on one parcel, typically the only realm of being able to get a lien release is just a piece of the land. You can release out piece of the land. In a single family realm where we do a ton of business, we do a lot of portfolio lending. So we'll take multiple parcels under one loan. Then it's extremely common for lien releases. The practical nature of when that happens is that each asset or each parcel is given a value of the loan amount up front. So we'll just use round numbers. Let's say it's 10 properties on $1 million loan, and each property is given a value of 100,000 each. What a lender will do is they'll allow you to release, assuming they approve it, they'll allow you to release one of those parcels in units, but they take what's called a turbo paydown. And that means that that unit was, let's call it, worth that $100,000. They will require you to pay $115,000 to release that $100,000. Now your loan amount is reduced by the $115,000. They're not making that extra $15,000 in money. But the reasoning behind all of that is that they don't want you to sell off all the cream of the crop parts of the portfolio. And then, we get left with an equal number of $100,000 for essentially the dog of the portfolio that really wasn't worth as much. So that's why we sort of force, when there's a release, we force a little bit more of the principal pay down on that allocated part of the loan. To protect our interest, to insulate us from how we're leveraged. But again, it's not like we're taking an extra profit on that. It's just you're paying down a little bit more principal than what was aligned to that parcel. So that might get a little confusing, but that's the true nuts and bolts on how that works.
In that case, you're saying, so that's still a single deed up front, but it's just because it's sort of more because it's land, kind of on the land side, sort of separate land have each of the units. And that's more common to do anyways.
I mean, what I was referencing is multi-parcels on one loan, but the one parcel splitting out, it's a little bit more unique in how it's looked at by each lender. But typically, if you're trying to split a property in half, that's 500,000 and 500,000 for a total $1 million loan. It's one parcel, and you can subdivide it and split it. A lender is probably not going to let you just split it down the middle. They're going to take a little, they're going to require you to pay down a little bit more of the principal balance, call it 600,000. So they're only remaining 400. And honestly, it's harder to get that approved when you're taking one parcel and doing lien releases. You got to put together a really good presentation to the lender.
Yeah, understood. But and in the case of just like units within a multifamily, you're saying, have you seen that ever approved as far as by lenders in that side?
Yeah. I mean, we've done it when people are going to build new, break off land and build something on it. We love doing it when we're going to write the loan for them to build the next asset. Okay. We do it very easily when that's the case, but we still do it, if it's right for the asset and for the business strategy, then most lenders are going to be willing to do it. Almost all big lenders, we're not loan to own. We don't want to own a property. We don't want to own your property. We just want to write good loans that, borrowers pay on. And in the real estate investing world, we need your business strategies to be successful in order for you to continue to pay and for the loans to perform and you to make money and we all be happy.
Yeah, makes sense. Makes sense. Any other questions, guys? If you wanna, we have a few more minutes. And thanks actually, Nathan, for putting the time.
Hey, Nathan, I'd love to hear more about the don'ts for submitting, things to submit to lenders.
Yeah, I love that question too. The don'ts is just don't be sloppy. Be specific. What a lender wants to see, they're underwriting you as a borrower and a sponsor, and they're underwriting, the asset. And if it's a permanent loan, they want to know that the existing asset can support the loan. Or if it's a bridge loan, they want to see the business strategy and plan. I encourage everybody to really make sure that you have a good, call it resume. You can call it a resume or, a write-up on yourself to present yourself well. So a don't is to, don't expect that you shouldn't have to provide much information. There's certainly some things providing too much information, but if it's going to show a strength in you as a borrower and a sponsor, I encourage you to include it and send it, even if it's not requested. And then when it comes to, putting together a package for a given deal, the more specifics you can show on what you see in the property today. And, if you're going to move it through a business plan, how you're going to navigate through that business plan, be very diligent in that. And then make sure that everything in between sort of matches up with what you present initially. So it all starts with just sort of having your ducks in a row, being diligent, expecting that you're going to need to provide some paperwork, and make sure that the paperwork you provide shows your strengths and the asset strengths rather than things that can poke holes. The other thing I'll just say, this is probably an obvious one, but don't lie to your lenders. Don't hide it. If there is a problem with your qualifications or the deal, it's much better for all parties to point it out up front, because as we talked about where we're at in the credit cycle, we know how to underwrite and we know how to investigate, and we're probably going to find it in one of the reports that we have to get to do the loan anyways, whether it's on you as a borrower sponsor or on the asset. So if there is some risk, it's always better to be forthright and show, hey, here's the risk, but here's how I'm going to compensate and mitigate this risk, and ask the lender for the decision rather than trying to sort of sweep it under the rug. Because when a lender catches that, then they say, okay, well, if I missed this initially, what else did I miss? And then you start to run into a hard time getting approvals because, an underwriter's sitting there thinking, oh, they got me on this one until I caught it here. Now I need to make sure that they're not sort of pulling the wool over my eyes in another area. So it's all very high level feedback, but have a good presentation on yourself, have a good presentation on your deal and your strategy with the deal, and then just be forthright and diligent with what you present to a lender.
Thank you. Great.
So in the permanent financing that we earlier discussed, what would you say is kind of a spread that investors may expect with, what you call, let's say, soft money lending or asset-based lending in comparison to, let's say, conventional investment property financing, or, I'm not sure if there is an apples, or let's say commercial agency loans or something like this. What would be, would it be 150 basis points or?
Yeah, so you're asking what would be the spread from a conventional type loan to maybe a more private lending loan? Is that sort of the question?
Correct. Yeah, when it comes to permanent financing.
Permanent. Yeah, another great question. First, just sort of taking a step back, that spread used to be extremely wide. And again, because of the institutional acceptance and money that's getting behind a lot of more niche lenders, the spread is tightened. I'm going to give you a wide range, so I hope this helps, but it really can be pretty wide. It can probably be as little as 100 basis points, maybe 75 to 175, 200 basis points. It all depends on the risk of the product, comparison risk of the product. But predominantly you see, we'll round it to the 100 to 200 range. The number you gave, man, 150 basis points is a pretty good one. But that would be more for a very cut and dry, down the middle, really well qualified sponsor in a really good market with a really good asset. A lot of permanent financing in sort of the agency realm is extremely competitive in that space. And, a lender has to be relying on their cost of capital to pass along an attractive interest rate to you. And so, some cost of capitals are extremely low, and that's where you see the bigger spread in delta. But 100, 200 basis points total. And if it's I think that's sort of the good range, and 100 basis points is usually sort of the tightest that you can get for more conventional to private lending. So you're probably going to ask me, why would you then use private lending? And I'll just give very quick answers to that. One, speed. Our speed to close a loan is easily 30 days, 3 to 4 weeks. Conventionals 45, 60. So speed is of importance. It's that. We're more common sense in underwriting, so we can take on a little bit more risk. That's why our rates are a little higher. So a lot of times people just can't qualify for the more attractive rates. Since we're also taking on more risk or willing to, our leverage is usually higher. So if one lender is only going to go to 70%, we may be 75 or 80. And so most people will pay a little bit of a premium on the rate to get higher proceeds. And then just ease of use and ability to grow in a relationship is very much our focus in the private lending space. Whereas, if you're looking more traditional banks, maybe not the agencies, but traditional banks, you run up against these max exposure limits that the banks have. And that's, they just don't understand what operators need, which is the ability to grow. And that's where we come into play. We understand that. And so we're more adept to allow you to take on more and more loans on top of what you may be able to do with conventional financing.
Yeah, that's a great summary. So do you expect the spread to tighten further in the future? Let's say institutional money came in up to this point. Do you expect this trend to increase, or maybe, okay, that was it, maybe that's the amount that already came in? So let's say, do you think that could tighten further? And let's say, where was the spread 5 years ago, or 3 to 5 years ago, when permanent financing private lending started?
I mean, to start where you ended, 200 to 500 basis points, difference in spread. I mean, from a single family perspective, you were talking like mid to high fours conventional, to 7 to 8% more private. So, pretty big delta. To the first part of your question, I do expect them to continue to tighten and compress. Now, there will always be a differentiation, because you got to remember, a lot of the traditional conventional financing sources, who are they backed by? The government. The government is printing their own money. So if we're backed by institutional, most institutions can't print their own money. The government can. And so the government backed stuff is always going to be a little bit cheaper as a result of that. But based on where we're at with the credit cycle, to that great question you asked earlier, I think that the non-traditional financing, realms are going to thrive, and they're going to allow for that tightening of spread between the two.
I agree. I think, to your point, it's an outstanding, like just not hitting on limits, like maximum property limits, like, even the whole like debt to income limits, et cetera, et cetera. It's a whole different level of flexibility. And so, yeah, that was great. So thank you so much for joining us today. So it was really informative to myself, and I'm sure to our audience too. I really appreciate you taking the time, and thanks to everyone for joining as well. Have a good night.
Thank you, Stefan.